Are you struggling to connect the dots between smart money concept and an actual trading strategy that works? In this video, I'll show you a straightforward step-by-step approach to turning smart money concept into a strategy you can trade with confidence. Welcome to my channel, where I simplify smart money concepts to help you achieve consistent results in your trading. By the end of this video, you will have a clear framework to start identifying high probability trades. So let's get started. So now, before we can go ahead with strategy, we have to understand the power of trade. The concept of the power of trade has to do with accumulation, manipulation, and distribution. So accumulation here is denoted here by this that we can see here. So we also know it as consolidation when the market is consolidating. And then manipulation, we also know it as reversal. So market is accumulating and then it reverses to rally higher. So this rally up here is distribution. We can call it expansion. Let me take this out. So it is similar to what I taught earlier before, which is the element of a trade setup. It combines what we know as consolidation, reversal, which is what we see as manipulation, and then expansion. So very simple. We want to see the market consolidate, then reverse or manipulate. That is take out sell side liquidity if it is to go higher, and then rally high, which is an expansion or distribution. So we want to see the market consolidate, take out buy side liquidity, which is a manipulation, and then expand downwards. So it is very simple. Now, this usually happens every single time. But now, in applying this strategy, we usually use the daily open. Let me explain something. Let's go to the previous slide. So now, this is a bullish candle. This is the open, and this is the close. This is the high, and this is the low. Simple anatomy. So usually when the market opens, it protracts lower. If it's going to be a bullish day, it protracts lower before rallying higher and then forms the high before closing below the high and also above the market open. Very simple. So when you want to apply the power of trade for this strategy, you want to use it at the very beginning of when the candle opens. You want to capitalize on this move. So it is very simple, very clear, but people usually trivialize it. If you're watching the market at opening, usually you will see the market going lower if it's going to be a bullish day. Now, it doesn't happen all the time. So when it is going lower, you will think the market is going to be bearish. Like you wouldn't want to be buying when you see market going down. It can be very scary. But when you understand this whole concept, you will know that market is only going lower to take out liquidity, to find support in an institutional level, or to fill in a void before rallying higher. Now, it's not always perfect, but usually this is the case. So we capitalize on that to make money. And that's what the whole strategy is based on. So you can see accumulation here, market accumulating, protracting. So this is the low here. Usually the market accumulates. For any move to occur, there's usually consolidation. You want to wait for market to consolidate before you want to enter a trade. You don't want to enter a trade as market is consolidating, but you want it to consolidate first. So explaining it again, you want to see accumulation and the market go below the market open. If you are going to be buying, you want to see a protraction below the market open, which you know as manipulation, and then boom, this is where we make profit distribution. And the reverse is the same for a bearish day if you want to be selling. All right, so let's go straight to the strategy. Now, this strategy involves 3 steps. Step 1, you want to outline the Asian range. And you do this in the 15-minute time frame. You see the Asian range clearly in the 15-minute time frame. Step 2, you're looking out for certain conditions. The first condition you're looking out for liquidity run on the Asian range high if you want to be selling, or Asian range low if you want to be buying. Then secondly, you're looking out for protraction above or below the market open. And you want to be seeing all these things happening when? At the London Q zone. And these conditions are very, very simple to outline. Step 3, you're going down to a smaller time frame, which is the 1-minute time frame. And you're going to be looking out for the lower time frame entry models. And they include the market shift plus fair value gap, the break of structure plus fair value gap, and then the inversion fair value gap. Now, this market shift plus fair value gap is just the ICT 2022 model. And then I explain all these entry models in a video. And if you want to learn more about the entries of these models, click at the button on the right side of your screen. So this is just a schematic representation of the strategy. So like I said before, step 1, you want to outline the Asian range. So you have the high and the low. And then you want to see a protraction below the market open happening where in the London Q zone. So you go down to, this is where you want to be going down to a smaller time frame. When you see this, you want to go down to a smaller time frame, that is 1 minute or even a 3-minute time frame to look for the entry models for a buy, and then reverse is the same for a sell. So usually you want to see the previous daily high and previous daily low left untouched. You want to see the Asian range formed in between this range. It mustn't be like this, but you expect you have a higher probability of price running the Asian range low and then at the same time running the previous daily low at the London Q zone. So this is a higher probability. So you mustn't see price run the previous daily low. I just added this to let you know how to locate high probability trades. All right, let's move on. All right, so here's an example. This is Asian range high and this is Asian range low. You outline it in a 15-minute time frame. So this is a 15-minute time frame. So after the day, you're waiting for the high or the low to be taken. So if the low is taken, what you want to do is you go down to a lower time frame. So you can see that this low was taken where in the London Q zone. Although this high was taken, but if you outline it, it was taken outside the London Q zone. And even if it was taken within this Q zone, this happened first. So as you can see, as it takes the Asian range low, it's also taking the previous daily low. So this mustn't happen, but this increases probability. So as this happens, the next thing you want to do is to do what? Go down to a smaller time frame, which is the 1-minute time frame. So let's go there quickly. And then you can see this is an entry model, which is the inversion fair value gap. So let me expand so we can see it clearly. As price takes out the Asian range low and the previous daily low, you can see that this fair value gap, which was from price, broke through it, came down, found support before rallying. Now, if you are entering here, which will stop here, at this point, you'll be getting 2 hours, if not more than 2 hours. So if I take it back so that we'll see this clearly, you can see that you'll make more than 2 hours in this trade. So if you should be taking your profit probably above this high, you're making like close to 4 hours in this trade. So it's a scalp, it's a quick scalp. This will last for about 1 hour to 2 hours, right? So I just showed this image here to let you know that I also use this strategy very well. So this is a trade I took and I made some profits. So if you look at it in the smaller time frame, which is the 1-minute time frame, this was how it looks. So you want to be fine-tuning your entries using the time frame. So you can see how it looks rough here with the 1-minute time frame. Although you could have, if I had seen this trade happening like this, probably I didn't take this, I didn't enter here, I would have been entering here. You can see how, let me expand, you can see how price came back to this inversion fair value gap. Here price disrespected it, came back down, broke through it again, then found support before rallying. So I could have been entering here. But if you go back to the 3-minute time frame, so let's go back. You can see how clear it looks. If I expand, you can see price broke through this inversion fair value gap here. Okay, it's not even looking good here. Let's go back to the other. So you can see how it looks here. Price broke through this inversion fair value gap. It disrespected it. Price should find resistance here before going lower, just like you can see here. Price actually found resistance here and then went lower. The same thing here. Price found resistance, then went lower. But at this point, price broke through it, disrespecting the fair value gap, telling you that price wants to go higher. So it's a sign that price or market wants to turn. So we are seeing it in a lower time frame, giving a good opportunity for an entry. So what are the favorable conditions to look out for? Number one, daily bias. So you mustn't have a daily bias, but a daily bias will help. If you are bullish for that day, all you want to be looking for is price to run below the Asian range low and below the market open. So you'll be looking for something like this for your entries. Then the next is time and price theory. I always keep hammering this. You don't want to be taking your trade outside the ICT Q zones. So the best Q zone you want to be using is the London Q zone, not the New York, not the Asian, not any other Q zone. You want to be using the London Q zone, as long as it has to do with the Asian range strategy. And then another thing again, which I mentioned earlier, is the market open. You want to see price going below the market open if you are buying, and then price going above the market open if you are selling. And the next thing you want to see a visible price protraction. You don't want to see price, let's say you want to be buying, and then this is the market open. And then let's say this is the Asian range. You don't want to see price fall, something like maybe goes down quietly. And then you look for I trade. Well, it might still work out, but what increased probability is that you want to see protraction. You want to see that move, taking out liquidity, and it usually happens in the London Q zone. If you go to your chart, you will see this happening there. So you want to see that. So let's go back to the chart. Let me show you an example. Like at this point, you can see this protraction. It's very clear. Like you can see this huge momentum. You are not seeing something like this. And you can see it's also outside the London Q zone. So you don't see something like this, something like there is a huge protract, like with huge momentum. So there you have it. Now the next thing you also want to see is that you want to see the previous daily low and previous daily high untouched. Now it doesn't mean that if liquidity has been taken here, that strategy won't work. But these are just favorable conditions. But mind you, this must be present. Another favorable condition is that you could pair the run on liquidity with an institutional level. So let's say there's another block here in the previous day, there's another block, and then this is an Asian range. So price could probably take the low and find support in the bullish order block for rally. So this increases the probability. This is a favorable condition. And then lastly, you want to be dealing with European pairs like the Euro USD, British Pound USD, Euro Yen, the DJ. You could also use the Euro Odd, the Euro Swiss, the Euro CAD. These are just European pairs. This strategy works best with the European pairs. All right. So now let's go over another example again with the favorable conditions in mind. Now you can see price. This is the market open. You want to be selling above the market open. This is the Asian range. You can see it formed a clear range. You're not confused, thinking is this a range? It's not a range. It's a clear range happening where in the Asian Q zone. So you can see how price ran above the Asian range. So once that happens, you want to be going down to a lower time frame. And this is happening where? Above the market open. So we're going to be going down to a lower time frame now. So here is a 1 minute time frame. You can see the market shift plus fair value gap entry model. This is the ICT 2022 model. And market broke structure to the I think I should expand. Let me expand it so we can see clearly. So here you can see how market broke structure to the downside here after taking this buy side liquidity and then leaving fair value gap. So here's a good entry. All right. So now you can see that this is happening where in the London Q zone. Let me just take it back. This is happening where in the London, this entry here, if you trace it down, it's happening. Sorry, it's happening in the London Q zone. So you can take this trade. It's very, very good to take this trade. And it's above Asian range, above market open. All right. So if you are entering here with a stop here, this will be like 1, 2, 3, maybe 3.5 hours. 3.5 risks to rewards. If you're risking 1%, you'll be getting 3.5%, which is very good. All right. So this is an overview of how the trade went. So if you had left your stop here, you can see the market did not take your stop. Even with this, you could still be entering. Now, how would you enter here? Here like this. Let me show you how. This will be using the inversion fair value gap. So you can see here, there's an inversion fair value gap here. And see how price found support here, rallied, then broke through it. As soon as it broke through it, it came back to find what? Resistance before running lower. But usually I wouldn't want to be entering this trade here because you can see that this high has not been taken. So I wouldn't trust this run here. Only if I see smart money divergence. Maybe if I compare, this is GJ, British Pound, JPY. So if I compare it with the UG and I see a smart money divergence, I'll be confident to be selling here. All right. So this is how the trade went. Let me take this out. So if you have left your stop here and allowed the trade to rally lower, you would have been making more than 3.5% on your 1% risks. So now we'll need to learn the rules concerning the Asian range. Now the Asian range is the highest swing high and lowest swing low formed at the Asian Open prior to London Open. Now the range must be between 8 p.m. to 2 a.m. Eastern time. That's the New York Eastern time. Number two, the range must be clear and not a continuous trend, period to Asian Open. So you don't want to see something like this, maybe from the previous day, and then let's say this is the Asian Open, and then you see a continuous trend going up. No, you don't want to see something like this. You want to see something probably like this, then a clear range happening. It has to be very clear. You don't want to see a continuous, because this already reduces the probability of the trade going in your favor. So you want to see a clear range. Then number three, the range in pips must not be above 40 pips. It shouldn't be more than 40 pips. You don't want to see something like this. Huge range. Then you want to outline the Asian range and then the Asian range high and the Asian range low, waiting for it. No, usually you don't want to see something like this. You want to see a tiny consolidation like this. Something, it doesn't have to even consolidate too much, but you want to see something, a range. Very simple to find a range. All right. And then you don't want to have multiple high impact news for the London session so that it doesn't messes up your trade. So these are the rules. If you keep to these rules, you will get a profitable setup to make money. All right. So let's move on. We're going to be reviewing the last example. You can see here that this is a range. You can see how a range was clearly formed. You can see how price range then formed another. This is consolidation. This is also a price range. So I think some people are asking what's the difference between consolidation and price ranging. So you can see here, this is a range actually. From here to here is a range. So price has been ranging within this range. So when it comes to the Asian range strategy, you want to see a clear range in the sense that it's not a trend like we can see here. Because I already established the fact that it should be more than 40 pips. Let me take this out. So this already is more than 40 pips. But you want to see a clear range where price formed a low and a high that is not more than 40 pips. I hope we understand that. So once we draw the high and the low, we're expecting a run on liquidity on either of the two sides. So if you go down to a lower time frame, you will see that there was an opportunity here and another opportunity here happening where in the London Q zone. Another thing we should also take note of is I did not outline it here, but here should be the market open. So this is happening where above the market open. So let's see if we get the sell. Let me take all this out so that we can move forward. Sorry, another thing I failed to mention is you can see that the high and low, previous daily high and low were not taken. So the previous daily highs and lows are actually targets for liquidity. Price usually runs to these places. Now, they could happen in two forms. Let's say price is here. This could be a drawn liquidity for price. So you can see how price went to take out the previous daily low. Another scenario could be price running to take liquidity for a reversal. So we know this as what? Manipulation. So price maybe, as you see, price ranging here, then just runs quickly to take this high to run lower. So usually the previous daily high and low are good target points. So we want to see them untapped. Usually they increase the probability of our trade going in favor. So going down to a smaller time frame, this is a 1 minute time frame. So I expand. You can see this is the inversion fair value gap again. So you can see the inversion fair value gap. Price usually should find support and then rally higher. So after taking liquidity, you want to be finding these setups. You don't want to just go to price and look for inversion fair value gap and then start selling or start buying. You want to see it happen when liquidity, a significant high or low has been taken. So the Asian range is a very significant high or a significant low, whichever. So when you see this happen, you can see this huge protraction. You can see there's a protraction. Already, I failed to mention this protraction. You can see it's very clear. You're not seeing something like this. Maybe price moving slowly. You can see this huge move. So price moved higher and then created what fair value gap. So price failed to find support. It actually did here, then broke through. As soon as it broke through it, it returned back to it. You can see it fell, returned back to it. So here's a good entry. And then it gave another opportunity here and then almost here, but it didn't get to it. So this is another good opportunity in case you missed this one. All right. So if we go down, let me reduce this. So you can see how price rally lower. So if you're entering here, let's say this is your entry and here's your stop. This will be like you'll be making 1 hour, 2, 3, 3.5 again. So this is a very good scalp. And then if you want to leave it for the rest of the day, that's when you want to combine this strategy with a daily bias. If you know the daily bias and daily bias, you are bearish for that day, you can be using this high to protect your loss, because usually the highs and lows for the day are formed at the London Q zone. All right, I hope this was helpful. If you enjoyed this video, please like and subscribe for more content. And if you have any question, please, I would like you to leave it in the comment section. And as always, I wish you good luck and good trading.